Most people spend their entire careers chasing a bigger paycheck, but the number that actually changes your life isn't on your pay stub. It's sitting, or not sitting, in your savings account, and it's not what you'd expect. Here's the thing no one explains about money. Earning more doesn't make you financially free. It just makes you look like you are. The math stays broken, the stress stays loud, the fees keep coming. There's a specific dollar amount where all of that changes, not because you're suddenly wealthy, but because you've crossed a line banks quietly hope you never reach. That number is $20,000. And this is where the real story begins. Daniel looked the part. 37 years old, stable marketing job at a mid-sized company, business casual wardrobe, a decent apartment in a decent part of town. The kind of life that, from the outside, reads as doing fine. But there's a version of financial stress that doesn't look like stress at all. It doesn't look like missed rent or empty refrigerators. It looks like Daniel, quietly doing math in his head before every purchase, checking his balance in the car before walking into a restaurant, knowing almost to the dollar how many days were left until payday. He carried a credit card balance, not a huge one, just enough to cover the gap between what I have and what life costs right now. He told himself he'd clear it next month. Next month became the month after that. The strange part, Daniel wasn't irresponsible. He wasn't buying things he couldn't afford. He was just living. And living, it turned out, cost slightly more than he ever seemed to have available. He had a theory about why. The same theory most people have. Income. If he could just earn a little more, the math would start working, the balances would come down, the anxiety would quiet. He'd finally feel like he was getting ahead instead of just keeping up. And then he got a raise. It wasn't a small one either. His salary jumped nearly 12%. For a few weeks, he felt it, a looseness in his spending, a lightness when he checked his account. He celebrated, quietly, took himself to a nicer dinner, felt for a moment like the math had finally shifted in his favor. But then something strange happened. 3 months later, the feeling was gone. The balance was back. The math was tight again. And Daniel couldn't explain where the money went because nothing dramatic had changed. He earned more. He felt just as broke. If income was the answer, why wasn't it working? Here's the thing about lifestyle inflation. It never feels like a mistake in the moment. When Daniel got his second raise, he didn't go out and buy a sports car. He didn't book a lavish vacation or blow money on anything irrational. He made reasonable decisions, modest upgrades, the kind of choices that felt like rewards for working hard. He moved to a slightly nicer apartment, not extravagant, just quieter and closer to work. He upgraded his phone when the carrier offered a deal. He added a couple of streaming services because, honestly, everyone had them. He started getting lunch out a few times a week instead of packing it every day. Each choice on its own made sense. Together, they quietly erased everything the raise had given him. That's how lifestyle inflation works. It doesn't ambush you, it seduces you. Every upgrade feels proportional. Nothing feels reckless. And by the time you notice the margin is gone, you've already adjusted to the new normal. Going backward feels like sacrifice, even though forward never felt like progress. Then came the car. A routine repair, the kind of thing that happens to everyone eventually. $600, not catastrophic, not even close to the worst thing that could go wrong. But Daniel's account couldn't absorb it. The charge dipped him below zero. An overdraft fee hit. Then the repair went on a credit card to cover the gap, and interest started quietly accumulating in the background. $600 became closer to $800 by the time it was settled. And the thing that stayed with him wasn't the cost, it was the pattern he suddenly recognized. Every time he got close to the breathing room, something pulled him back. A fee, an interest charge, an unexpected expense that wouldn't have been an emergency if he had a cushion. He wasn't unlucky,
He was exposed, and the system he was operating inside was perfectly designed to profit from that exposure. What if the system doesn't break when you're broke, but specifically when you're almost stable?
Daniel didn't have a dramatic financial awakening. There was no single book, no viral video, no moment of crisis that cracked everything open. It was quieter than that, more like a slow-building question he couldn't ignore anymore. What would it actually take to feel okay? Not rich, not retired early, just okay. The kind of okay where a car repair is annoying, not catastrophic. Where a bad month at work doesn't trigger a cascade of financial decisions. Where he could look at his checking account without a small knot forming in his chest. He started reading about emergency funds, real ones, not the save $1,000 just in case advice he'd heard before. Something more substantial. The idea of 3 to 6 months of actual living expenses sitting somewhere accessible and untouched. For him, that number was somewhere between $15,000 and $20,000. It felt almost absurd at first. That was more money than he'd ever had sitting still. But he started treating it like a goal rather than a fantasy. The first milestone was $10,000, and he'll tell you something did shift when he crossed it. A small but real reduction in background anxiety. A sense that one bad month wouldn't immediately become a financial crisis. But it wasn't quite enough. The relief was partial. He could still picture scenarios where $10,000 disappeared quickly. Then he crossed $20,000, and something entirely different happened. The mental math stopped. Not because life got simpler, but because the stakes changed. Car needs repair? He had it. Unexpected medical bill? Stressful, yes. Catastrophic? No. And then, the thought that surprised him most, when his manager became unbearable, he realized he could leave. Not impulsively, but if he needed to, he had time. He had options. That's what $20,000 actually bought him. Not things, options. When he crossed $20,000, something strange happened. The fear disappeared. The changes didn't come all at once. They arrived quietly, the way most real transformations do. Not as dramatic shifts, but as small things that stopped happening. The overdraft fees stopped. This sounds minor until you realize how often they were occurring. A payment clearing a day early, a bill auto-drafting at an inconvenient time. The margin had always been thin enough that the timing of things mattered. With $20,000 in savings, timing stopped being a threat. The credit card balance came down, then disappeared. He still used the card for the points, for the convenience, but he paid it in full every month. The interest stopped. The minimum payment became unnecessary because there was no balance to carry. He was using the card the way it was designed to be used, instead of the way that made the company money. The maintenance fees vanished. The minimum balance requirements that used to quietly charge him $3 to $12 a month simply stopped triggering. He'd crossed the threshold where banks charge you for not having enough, which, if you think about it, is one of the more quietly cruel features of the financial system. But the deeper shift wasn't in the fees. It was in how he made decisions. Before, financial decisions had an urgency to them, a pressure. He said yes to things he shouldn't have and no to things he should have pursued, all because scarcity was shaping his judgment without him fully realizing it. When you're operating close to zero, your brain is constantly managing risk. That cognitive load is real and expensive in ways that never show up on a bank statement. Now, decisions slowed down. He could think. He could wait. He stopped reacting to money and started directing it. He made savings a fixed expense, the first bill he paid, not the last, not what was left over because there's rarely anything left over. A set amount moved automatically before anything else touched his account. He didn't feel richer. He felt untouchable. Something interesting happens when your emergency fund stops being an emergency fund and starts being a permanent fixture. It just sits there, untouched. And that untouched money begins to do something new. Before, whenever Daniel accumulated savings, they functioned as a buffer, a temporary cushion that would absorb whatever went wrong next. The money would build up, something would happen, the money would be gone. Save, spend, reset. The cycle never actually compounded because the savings never lasted long enough to grow. But once the 20,000 was established as non-negotiable, protected, off limits, the floor below which he simply would not go, his relationship with new income changed entirely. Raises didn't become lifestyle upgrades anymore, they became building material. He started investing, small amounts at first, index funds. Boring, low-cost, automatic. Nothing dramatic. But unlike before, this money had no crisis waiting to claim it. It stayed invested. It grew. And then it grew on its growth. That's what compounding actually requires: time and continuity. Most people understand the math. Fewer get to experience it because the money keeps getting pulled away before the curve has a chance to bend. Daniel got to experience it. But the most surprising form of compounding wasn't financial, it was psychological. With financial security came patience. He stopped making decisions from urgency. He negotiated his next salary increase with calm confidence because he didn't desperately need the raise, he just wanted it. That shift in posture changed the conversation entirely. He got more than he asked for. He started saying no to projects that didn't align with where he was going because he could afford to. He started asking better questions, taking longer views, making bets that required a runway he finally had. The margin he built wasn't just protecting him from emergencies, it was amplifying every good decision he made. The real compounding wasn't happening in his account, it was happening in his mindset. At some point, Daniel stopped blaming himself for the years he'd spent financially stuck. Not because he was without fault, but because he finally understood the shape of the system he'd been operating inside. And once you see it clearly, the struggle makes a different kind of sense. Banks generate billions every year from overdraft fees. Credit card companies build entire business models around the float, the interest accumulated when people carry balances they intend to pay off but never quite do. Financial products are frequently designed to be most profitable when customers are close to stable but not quite there. The customer who barely qualifies, who needs the card, who will carry a balance, that's the valuable customer. Daniel was that customer for years, not because he was irresponsible, because the margin was thin enough that the system could reach him. Below a certain threshold, you play financial defense. Every dollar has a job, and most of those jobs involve preventing something bad. You're managing exposure, absorbing hits, trying not to fall behind. The system profits from that position, quietly, automatically, without malice, just design. Above that threshold, the dynamic flips. You play offense. Money moves toward growth instead of protection. Decisions get made from strength instead of scarcity. You become, in the language of finance, less profitable to the institutions that were quietly billing you for being vulnerable. Daniel didn't need to earn more to cross that line. He needed margin, breathing room, a cushion large enough to absorb life's randomness without requiring debt. The hustle culture version of financial success says, work harder, earn more, and eventually you'll be free. What Daniel learned is that freedom doesn't come from the earning. It comes from the buffer between what you have and what you need. Wealth isn't about increasing your image, it's about removing your vulnerability. The moment you stop needing to borrow is the moment you stop being controlled. Daniel told me that the moment he realized things had truly changed wasn't dramatic. He was driving to work on a Tuesday morning, nothing special about the day, when he noticed he hadn't thought about money in weeks. Not in the anxious, calculating way that had been background noise for most of his adult life, not the mental math before purchases, not the silent dread before opening his bank app. It was just quiet. He hadn't gotten a windfall, he hadn't been promoted to a salary that changed the game. He'd simply crossed a threshold and stayed there. He thought about the version of himself from 5 years earlier. Same intelligence, same work ethic, same intentions, but operating in a constant state of financial exposure that shaped every decision, sometimes in ways he didn't even recognize until much later. The difference wasn't effort, it was architecture. Income made him look stable, savings made him independent. Those are two completely different things, and for a long time he mistook one for the other. $20,000 isn't a luxury milestone, it's not the beginning of wealth, it's the end of vulnerability. It's the number where the system stops profiting from your uncertainty, where emergencies stop being existential, where your decisions start reflecting your values instead of your fears. It doesn't feel like what financial success is supposed to feel like. There's no celebration in it, no status, no visible signal to the outside world that something changed. That's the point. The most important financial milestone of your life is one nobody else can see. So here's the question worth sitting with. Where are you right now relative to that line? Not in terms of judgment, but in terms of strategy. Is your next financial move about looking more successful or about becoming harder to destabilize? You don't need to be rich. You need to be unshakable.